Hello everyone, welcome to this webinar. I'm Peter Towers, Managing Director of Towers Business Development. Happy new financial year. I really hope that 2021-22 will be a very successful year for you in your business. If you have any questions during the webinar, can you please go into chat and type in your question, and I will respond to your questions later in the webinar. If you are watching this webinar other than on a live feed and you have any questions, can you please send me an email, peter@towersbusiness.com.au, and I will get back to you with a reply. Today's subject is looking at virtual Chief Financial Officer services could help launch your business in 2021-22. I really believe that's possible, and I know that it can be achieved by businesses. How will you go about launching virtual Chief Financial Officer services into your business or company or club or whatever you are associated with? I think all businesses need a top-level financial input during the year, not at the end of the financial year when the tax return's been prepared, but during the year. It might only be for the equivalent of half an hour a week, or it could be an hour a week, or it could be 2 or 3 hours a day. It depends on your own situation. And we're going to work through some of the issues that a CFO could handle within a business, a company, or whatever you are running. My background is I was the Chief Financial Officer of a listed public company. I was also the company secretary for some years. And I have been the principal of an accounting firm where I've used a lot of the principles I learned from my public company experience and how individual businesses are looked at and analysed. And I'm also the Managing Director of ESS BIZTOOLS, and we produce material for accountancy firms all over Australia and some in New Zealand to utilise to offer this type of service, more of a Chief Financial Officer service. So we don't do tax, and we're trying to encourage accountants to be able to diversify their services. And this is our consulting arm, and we're talking to you about the presentation of Chief Financial Officer services. So where would you start? I think you start with a one-on-one meeting. You sit down and talk to your client. And this is what I would be doing with people that are watching this webinar, because I assume most of you watching are business people or your accountants wanting to have an understanding of how this process might work for them. The document we use is a document we produced called the SME Needs Analysis. And this is a series of questions and comments and information that as a CFO, I can be talking to the client about, to you about, to understand whether this is something that you would want me to be looking at and handling as part of a virtual CFO role. So I want to work through some of these items with you now. Current business performance. This really gets back to our separate financial accounts being prepared, or is everything getting put into one profit and loss account? Are financial accounts being prepared on a regular monthly basis? Are key performance indicators being prepared? Are they being analysed? Are they being evaluated? Is there feedback going to the managers or whoever's in charge of individual operations so they can see the financial analysis on their performance? This is part of the role that I see that a Chief Financial Officer would be providing. We need to look at business analysis. What is really happening in the business, and how is that being utilized to gain meaningful information that the business operator can utilize for the benefit of the business. Departmentalized financial accounts I already mentioned. So that means if you've got a wholesale business and 2 or 3 retail businesses, and you have a transport operation, you have and some of those properties are owned, that you would have separate P&Ls for each of those operations. You'd have a internal asset holding entity which would own the buildings and charge rent to the operations, so that you're able to get standalone financial accounts for each activity. At the end of the financial year, it can all be consolidated together into one P&L account for taxation return purposes. That would be done by your taxation accountant. But the main thing is, for management purposes, I firmly believe that every business needs to have separate accounts. If you're in a medical type business and you've got different activities, you might have physiotherapy, you might have other services under various specialities, that you would have separate financial results being prepared, not just the gross income, but dissected down to bottom line profitability, so you can really evaluate how that business is performing. If you're a manufacturer or a professional service firm, or even many tradie type businesses, that's what you're operating, you need a job costing system, which illustrates how the business has performed on the individual jobs that's been taken on for customers, so that results can be determined. Because if it's all just put into one profit and loss account, the tracking of the individual job can be very difficult. And you may find that you've suffered a loss or a significant decrease in your expected result in a month. And if you haven't got a job costing system, it can be very difficult to dissect that. So I think wherever a job costing system is envisaged, it should be there. So if you're billing on individual jobs, it should be there, so that you can have a discussion. Ratio analysis. Ratio analysis get back to things like gross profit percentage, percentage of growth in from one month to the next, average sales per employee. This is key information that relates to the formulation of key performance indicators that management can understand. I think one of the challenges for anyone offering any sort of CFO service is to be able to ensure that these reports that accountants can prepare have been explained to the managers and to anyone else in the team that's going to be receiving those reports, so they clearly understand them. Years ago, I was in the meat industry. That's where I was a CFO in a listed public company. And I found that the foreman on one of our major meat works were not bothering to read the daily key performance indicator report that someone in the office went to a great deal of effort to produce and send it to them. I inquired why they weren't doing anything about it and were never asking any questions. They said, we don't understand it. The terminology doesn't mean anything to us. Doesn't relate to the work environment that we work in. So I sat down with them and we changed the key performance indicator reports. We put it into the language that they understood. And it then became a very worthwhile document because they had some buy-in, they had some ownership as to what that document looked like and what it told them. And things went a lot better after that. So I see part of the role of a chief financial officer is to make sure that the people that the reports are intended for do understand them, do have confidence in them so that they can implement changes. Debtors management. Most businesses have got debtors because most businesses are offering credit. If you don't have to offer credit, that's great. Stay that way. But if you're offering credit, you've got to manage your debtors. An important part of the CFO role is to make sure there's an adequate debtors system that's been implemented, that the initial review of a potential new customer is properly attended to. Businesses are not obligated to accept everyone that walks into their store or workshop or factory or professional office and says, we want to open a credit account. That's the prerogative of the business supplying services to say whether they'll accept a new customer or not. And you need to get basic information, where to send the invoices, what particular additional information does this new customer require sent to them each month with their tax invoice so that they will make payment. What's their payment conditions? Do you give them a new customer letter spelling out your terms of trade? Have they signed the documentation relative to terms of trade and retention of title? Has the business made a decision whether it's going to register that customer on the personal property securities register? And then you need to make sure that the customer has returned those signed documents promptly, because there is a strict timeline in which that registration on the personal property securities register needs to be made. I think part of the role of the Chief Financial Officer is to make sure that the management team, and most importantly, the person who's handling the debtors in the office, understands what this personal property securities register is all about. Unfortunately, I've discovered that many people don't. What's the debtors' days outstanding? When are the debtors' statements, if they're still sending debtors' statements out, when have they been dispatched? Is it 24 hours after the end of the month, or is it 18 days? If it's 18 days, don't expect the debtors' days outstanding to be very good. It would probably be disastrous, because a lot of businesses won't pay until they receive that statement. Budgets. A budget's been prepared just by taking last year's figures and adding a percentage for CPI? Or are you going back to the basics and starting to build up a whole profile of what's going to happen? What's the sales estimates that says how many widgets could be sold? What becomes the production program from there? What's the supply of raw materials look like? Are you receiving raw materials from some markets which might not be open or available to this business for a certain period of the year, in which case they will need to stockpile or find alternative suppliers? So budgets should really be predictive accounting, looking clearly at what is likely to happen next week, next month, and over the next year or 2 years. Not just taking last year's figure plus a percentage. And if we've learned anything over the last 18 months, the world changes pretty quick, doesn't it? We got these lockdowns that seem to just occur like that. How's that going to affect the budget? Cash flow forecasts. Once again, it's not last year's plus a percentage. It's actually working through the budgets, looking at the buildup of stock. Stock might build up at particular times during the year. Has that been factored into the cash flow forecast? Have we got realistic predictions for debtors? Or has the cash flow forecast been done on the basis that everyone will pay in 30 days, yet the debtors' days outstanding sitting on 53 days? That's unrealistic, and you're going to get the wrong financial forecasts. What other cash payments need to be brought into account? Loan payments, dividends, capital expenditure, major research and development projects, all need to be thought through and reflected in the cash flow forecasts. Projected balance sheet. I'm an advocate that accountants and CFOs should be utilizing predictive accounting tools. We use Plain Guru to ensure that it's a 3-in-1 financial forecast. So we're looking at budgets, cash flow forecasts, and the projected balance sheet. What's the business going to look like in 2, 3, 4, 5 years' time from a balance sheet point of view? Business modeling. I don't think enough business modeling is being done. And this gets back to the CFO having a discussion with the managing director of the business or the owner of the business. Where could things be changed? How many customers do you currently get each week? What would you have to do to get an extra 5% of customers? What promotion would you have to do? And if you got an extra 5% of customers and you were able to get them to come a little bit more regularly to your business, perhaps your current statistic is 1.5 times a week they might visit your business. If there were some promotions and activities and giveaways, would they come 1.8 times? So factor that into the modeling. And what about the pricing? Could there be some variables made in the pricing? Are they really buying the great products you're wanting to sell? Or have you got all of your cash cow type products at the front of a store where they can just go and get them and walk out without wandering around the store trying to find those items? And whilst they're doing that, they come across other products, your star products, things that have got high markups. Accountants can make a real input into the planning that a business is doing as to what it is trying to sell. When I was a CFO in a listed public company, I reckon I spent around 3 hours a day, sometimes 10 hours a day, answering what if questions coming from the CEO and other members of the leadership team. Can we change this? Can we change that? What happens if we sent this meat to Russia rather than to Korea or Japan? What's the extra costs? How much more have we got to recover? These questions occur in public companies because I've talked to other people that have undertaken these roles in public companies, and the CEOs are always asking questions. This also happens in smaller companies, companies that are aspiring to scale up. Turnover currently might only be $1, $2, $3, $4 million. So I see the CFO role is to set up a mechanism where those questions are answered. We can use the communication, we can use Zoom. Some of it might be conveyed in personal meetings, but we need to acknowledge, I think, that the person who is running a business probably has quite a number of questions each day that he would like, or she would like, to be able to ask their key financial person, because that's what happens in bigger organizations. Management of costs. I think it's a vital part of the CFO role to look at how the costs of the business are managed. A few years ago, CCH conducted a survey where they interviewed business operators all over Australia as part of a report to the accounting industry. And accountants were also interviewed and were asked to supply their list of what they thought the 5 major problems were for businesses. And businesses did the same thing, what they believed the 5 major problems were. Management of costs was rated #1 by the businesses, their most important consideration. You know, when the accountants did their analysis, they didn't even rate it in the top 5. They, in effect, gave it a 0. Wasn't one of the top 5 items. Strange how accountants could be so far off the mark. I think it's very important, the management of costs, and it's most definitely part of a CFO role if you were looking at engaging someone. So that's the analysis of matters that are brought up in the SME, small business. I'll just go back to the SME needs analysis. And we're just now going to work through and go to the next item, which is business valuations. I think companies that are growing, definitely companies that are scaling up, but every company, every year should have a valuation, an updated valuation based on their performance. Valuations in lots of ways are in the eyes of the beholder. The average public company in Australia on the Australian Stock Exchange is valued at about 15 times their after-tax profit. There are some companies that are valued considerably higher, and unfortunately, there's some that are a bit below, but the average is about 15 times. If a company's undertaking an initial public offer, an IPO, the rule of thumb is that they're normally valued at about 10 times. They're not going to be valued at 15 times because they're not a public company at this stage, but about 10 times. The average private company is valued at somewhere between 3 and 4.5 to 5 times their after-tax profit. But what can happen is if a business has implemented proper systems, they've got systems manuals for everything. They've got a virtual CFO in their engagement. They're producing detailed monthly departmentalized financial accounts. They're updating their budgets and cash flow forecasts each month. They're acting like they were a listed public company. It tends to encourage the valuer and therefore the directors of the company to be saying, well, we should be getting valued at a price earnings ratio of 7 times the after-tax profit, or even 8 or 9 times. And that can mean a lot to a company as it's going through the growth pains that businesses have to do if they're going to scale up. Might keep them encouraged to keep their shoulder to the wheel. Expansion planning is very important, and it's most definitely a key role of a CFO if you've got one working for you. What's going to be involved in building a new factory, a new shop, a new gymnasium, a new office, whatever? What are all the costs? How are we going to fund it? Another key area for a CFO to be looking at is financing costs for things like debtors. And I'm just checking, I've got no questions yet. If you've got any questions, please send them through to me. But financing for debtors, debt financing, getting advance payments based on the invoice that you've produced for one of your customers may be the answer to helping cash flow difficulties. Financing of stock. There are various banks and companies which will finance stock purchases. They normally issue an overall figure. The company has to supply information to them, as you do on debtors factoring, to the financier every month. But stock purchases can be financed. And obviously the financing of your expansion, which is what we've just talked about before, is very important, part of the CFO role. But I think one of the most interesting areas for a CFO to get involved in with a young or a growing business is scaling up. This whole concept of looking at where you want to go. Your turnover is currently $2 million and you aspire it to being $5 or $6 million in 2 or 3 years' time. How are you going to get there? Well, there's a few things that need to be considered. Businesses that are going to scale up need to have people who are motivated and trained and enthusiastic, able to make decisions. And they're normally in two groups. There's a leadership team, and then there's the other team members. But they all need to be trained and motivated, and to have their job descriptions and their clear understanding of where they fit in the overall business jigsaw. So people are very important. People run companies, not machines, not computers. Scaling up requires the development of a strategy for a whole range of things. It might be on a factory, it might be on the raw material supplies. Who are the suppliers? Customers. How the products are going to be produced. What sort of reports are going to be prepared? How you're going to market the business? How you're going to sell products? Who's the salesperson? This is all strategies which is best written down, and the CFOs get very closely involved in that. And I think it's a good idea to have someone who's not involved in the day-to-day work within the business, because they tend to get tied up in other activities. And how are you going to execute these strategies? Within reason, anyone can sit down and develop 20 strategies for a business. But the real challenge is how they're executed, how they're implemented. Otherwise, it's just notes on a sheet of paper. Doesn't mean anything. But it's the execution of those strategies which really determine whether this business is really going to grow, if it's on a scaling up process. And a very important area, especially for a virtual CFO, is where is the cash coming from? Because as businesses grow, they need more money. And a lot of leadership team members really don't appreciate that. They say, but we sold an extra $2 million worth of product. Why have we got no money? Well, the money's likely to be tied up in debtors. Money still owed to you by customers, not yet paid. Especially if your debtors days outstanding is blown out to 85 days. The second area can be in inventory. We got carried away with enthusiasm, and we've now built up this $2.5 million investment in inventory. Could it be reduced to only $1 million? Is anyone really watching it and saying, hang on, we need to control investment in inventory? And if you're in a factory or a trade type business or even a professional business, there's another category also, and it's called WIP, work in progress. You need to keep a close eye on it also to make sure that it doesn't balloon out to some very large figure. It should be getting rolled over, I think, every month, either by progress claim invoices going in or getting cleared out because the job's been finished. Sometimes it can be where a bad job sits for months because some management person doesn't want to bring the result to the notice of everyone, because if it's invoiced, it will probably show that this wasn't such a good job. We lost money on it. So they're the key things on scaling up, which a CFO can do a lot of work on to help a scaling up company, which normally will be a small company wanting to grow its turnover. Funding for businesses. Now, for years in Australia, I think about 35 years, all that a private company had to be able to borrow money, obtain investment, I used the wrong term there, from the public was Section 708 of the Corporations Act without having to issue a prospectus. But that was limited to only 20 investors in any 12-month period and a maximum capital raise of $2 million. It wasn't really good enough. And the other real problem with Section 708 is a private company can only have 50 shareholders. So you didn't have to do too many capital raises like under this Section 708 to find that you'd run into problems on the 50 shareholder limit. And that was it. You then had to convert to an unlisted public company. But 4 years ago, the government gave us 2 new types of companies to help SMEs raise money from the public. And we were just playing catch up on other countries like New Zealand, Canada, USA, and the United Kingdom, where crowdsource funding equity raising has now been operating for over 10 years. And it's been very, very beneficial to the small, medium-sized business community in all those countries. Crowdsource funding equity raising. If the company has a turnover under $25 million, that's a group turnover worldwide, and gross assets also under 25 million, group basis worldwide, the company is potentially able to raise up to $5 million direct from the Australian public in a 12-month period by issuing ordinary shares to those people. Now, obviously, there's a process. It's all covered by the Corporations Act. But as a CFO, you would be guided through that process. The directors would and leadership team would need to be fully aware of how it works and the role of other people like the crowdsource funding intermediary. But it's a great way of raising capital. Well over 100 companies around Australia have already raised capital. Some have gone back for extra capital on 2 or 3 times. And you can go back the next 12 months and raise another $5 million if the board of directors agreed. The only limitation is the market prepared to keep on investing in your company? It's well worth looking at. And we got early stage innovation company. Now, this was the running mate for crowdsource funding. And it's been implemented for young companies, companies under 3 years of age who have got expenditure under $1 million in the previous 12 months and income under $200,000 in the previous 12 months, who have undertaken research and development, who can pass 2 tests out of 3. They could be eligible. And the real benefit there is there's some attractions that the government's built in for investors. The company gets the investment dollars, but the investors can gain a taxation benefit based on their investment in the company, and they can potentially avoid capital gains tax on those shares that they've been allocated in that company. It's well worth looking at. So companies are not restricted to having to go cap in hand to banks and other lenders. And once you do that, of course, you've got to find property you can offer as security. And you've got to have directors or leadership team members or shareholders prepared to sign personal guarantees. And then the company, of course, has got to make monthly payments of principal and interest. You have none of those problems if you have people contribute capital to your company. Of course, the percentage of the shares is going to be allocated to these investors, but that's part of the balancing act that you have to look at. And a CFO will be able to take you through all of that to make sure that everyone understands. Research and development. I think there's going to be more companies in the next 12 months, maybe 24 months, apply for a research and development incentive rebate, because a lot of people would have been doing some tinkering during these lockdown periods that have been caused to us over the last 18 months and may have developed a good idea or a concept in their shed, in their office, on their farm, or just when they woke up at 3 a.m. and thought about a particular business issue. So they may be able to pursue a research and development incentive rebate. As a CFO, we'd be able to guide you through on that process. We'd also need to look at cash flow cycles that occur for every type of business. Not quite relative to research and development, so these are separate items. The sales funnel calculation, how much activity's got to be put in at the top of a funnel to generate the number of customers the business needs. This is part of the budgeting process. To get 1,000 customers to deal with you and to pay whatever the price is, $5,500 or whatever for a particular product, then might need to be contact made with 15,000 people in the first place. What's that going to cost? Who's going to organize it? What's the ongoing promotion to have that achieved? So the CFO needs to clearly understand the sales funnel calculation. What's got to go in at the top to get enough coming out at the bottom? Sales metrics. Sales metrics have always fascinated me because I was in the meat industry and we look at different types of products or delicatessens or processed foods. There was always star items. You could sell a lot of it and you got a good markup. And that would be great if you could have that in your business all the time. But unfortunately, there are other products that the public likes buying and they're called cash cows. There's a lot of them sold, but there's a very small markup. It's the things that I think retailers and or wholesalers should hide in their stores. Make the customer go on a bit of a treasure hunt to find them and put alongside them a star item. There's always the chance that when they pick up that newspaper or that milk or that loaf of bread, which are normally cash cow items, that they will pick up the beautiful tomatoes that are sitting next to them that are a star product. So it's very important that the CFO has been able to communicate with the leadership team and the general employees to make sure they realize that these classifications within a stock matrix are very important. And one of the key roles in looking at how a business is going to utilize a CFO is making sure there's going to be working capital control. And we talked about the key components earlier: debtors, work in progress, inventory or stock are the three assets. And then we have creditors, what's owed. I don't think there's enough thought given by a lot of businesses to negotiating creditors payment terms longer than, say, 30 days. Could you get longer? Maybe special times in the year. I had a customer, client in my accounting business years ago who was a very big jewelry store business. He used to negotiate with overseas jewelry manufacturers to order stock in October, have it delivered in November, early December, but not have to pay for it until after Easter, which put it around April, so that they could control their working capital investment. One of the things I found in a public company was the utilization of weekly performance estimates, weekly profitability estimates, if you like. We prepared them for every operation. There were hundreds of them each week, prepared by the local team. Why? So that the person who was responsible for that local operation, the manager, got a result together with key performance indicators. And in each area, we had an area manager or an area director, and the results of a dozen or 15 individual business units would go to that person. And there was always an accountant then who would sit down and communicate to the boss in that area so that he or she clearly understood how the business had performed. And if it wasn't up to expectations, obviously he could immediately follow up with that individual manager. And then all that information got channeled through to head office, where I had a very experienced lady who was able to analyze all this, and we prepared a report so that the CEO had it by midday on a Wednesday. And that's when fireworks might have erupted if he got reports And when he rang the managers or the area manager, they didn't seem to have done anything about it. He wasn't very happy when that happened. I think this is part of the accounting role, not to wait for monthly accounts, but to look at doing things regular each week by having weekly performance reports. Another role for a CFO, of course, is to look at one of the biggest risk areas that businesses have, and that is, have we insured for them? Now, you can't insure for everything, but the team should know what risks have been taken without taking insurance. And risk management, well, we've had COVID-19 virus. It's one of the biggest risk areas we've had in recent times, but there are a lot of others. And every business should have evaluated what the risks are and make sure they've got policies to implement if that risk occurs. So virtual CFO services are now being provided to SME, small, medium enterprises all over Australia. A lot of businesses are realizing the benefit of being able to get the input of an experienced commercial financial officer who can talk the talk, who can understand the business, who's dug into that business and understands how it operates, understands the key performance indicators, make sure that the key performance indicators can be understood by the leadership people that they're targeted at. This is a great waste of time if they don't. Towers Business Development can supply these types of services to you if you're interested in having a virtual CFO service. So we've got some upcoming webinars, which are all part of this general promotion of the type of services we can do. Government grants are very important, and you can come to a government grant webinar on Thursday, the 8th of July, next week. And we've just talked about the early stage innovation company status. We have a special webinar on how that all operates on the 15th of July that you might find very interesting. And the following week, we're going to look at in detail Section 708 of the Corporations Act, which allows you to raise up to $2 million from a maximum of 20 investors in 12 months without having to issue a prospectus. Now, you can register for any of these webinars by going to our website, please, www.towersbusiness.com.au. And that will get you access. I'm just going to check again to see whether we've got any questions. We've got no questions. Hopefully that means that I've answered all of your questions. But if you're watching this later on or on a live feed and you would like to ask me a question, please send me an email, peter@towersbusiness.com.au, and I will get back to you. Or you can visit our website, www.towersbusiness.com.au, or you can send me an email, peter@towersbusiness.com.au. Or if you want to talk to me, 1-800-232-088 will get me. Thank you for the opportunity of being able to give you an overview of what I perceive the role of a virtual Chief Financial Officer is. I hope this helps you. And if you want further information, please contact us. Have a great day and best wishes for a very successful 2021-22. Let's hope it's a better year than last year. And I hope this is going to be beneficial to you as you take your business forward. Have a great day. Goodbye.